aspects of finance and accounting for over 20 years. She is a qualified CPA in the state of Indiana in 2001, where she started her career in public accounting. She shifted to mergers and acquisitions when she came to work at Certified Marketing Consultants. Jamie has been involved in consulting of both supplier and distributor companies in the promotional products industry for 14 years. Her passion is helping her clients meet or exceed their financial goals. I know Jamie personally from her service to our industry, and I'm so thrilled she could join us today. Please welcome Jamie Watson. Hi, Jamie.
Hi there. Thanks, Kelly. Thanks for having me. I'm really excited to talk to everybody today. So my role, just so you know, I'm not just somebody up here. I'm a partner at Certified Marketing Consultants. And so just a little bit about us. We're a cradle to grave consulting firm that specializes in this industry. So we have a lot of industry KPIs. We have a lot of industry contacts, and we really just spend all of our time here in the industry. And we work with business owners on building, valuing, managing, and eventually sometimes selling their promotional products companies. So we work with both distributors and suppliers and both buyers and sellers. So we see just a little bit of everything, actually. And most recently, we've actually partnered with a firm that's going to enable us to offer tax planning and preparation services to further help retain as much of their cash flow as possible. So when I was discussing this session with Andrea from Vernon, we talked about a number of topics we could cover, and I just thought, like, why not just give people what they want? So I'm just going to cover some of our most asked questions and just really the questions that we get asked all the time, and hopefully that'll be really helpful for business owners who are really examining the financial side of their business and further help them plan for the future. And everybody's trying to plan for the future right now and just do something to try to kind of normalize where they're at. So a lot of these revolve around selling a company because that's what we do most of the time. But really, when you think about it, building a valuable company just enables you to implement best practices that make your company viable for the longest period of time, even if you're not planning on selling it anytime soon. So I can't stress that enough, that even if you're not planning on selling, building your company in such a manner that it makes it valuable can only strengthen your financial position for your employees, for your shareholders, for your suppliers, and for your customers. So really all of your stakeholders. So I'm going to dive into the number one question I got asked, and this is a 2020 question. This isn't a question I always get asked this year. The question I got asked is, what's the market like? What's going on out there? You know, what can I expect? And I get asked this by buyers and sellers and suppliers and distributors. So it's safe to say that 2020 was a pretty big mess, and the people that were selling their company in 2020 were the ones that had to. That's what I've encountered anyway. If anybody was struggling at the beginning of 2020, they probably didn't make it through the year, if they were not in a good financial position. And that's why it's so important to build your company to be as resilient as possible, even if you're not thinking about selling it. So now that we have gotten to a point where things have started to, I guess, normalize a little bit. I hate using that word, but that's really the only word there is for it. The market's changing a little, and that's for two reasons. Hopefully we're getting back to normal, and also the idea that life has to go on whether it's normal or not is getting to be becoming more front and center. So people have adjusted somewhat, and they're looking to reignite their plans on whether they want to retire, buy a company, sell a company, etc. So the market is picking back up a little bit from what we can see. So that's kind of my analysis of the market. It isn't, it's not really, I would say I have a lot of buyers out there right now, a lot of hungry buyers, because there's not a lot of sellers. A lot of people are kind of just scared, or sales are down, so they think their company's not going to be as valuable. So if they don't need to sell it, they're not selling it. That's kind of where we're at there. So that kind of leads me to question number 2. What should I know about selling a company? That's a question I get asked a lot, just a general, what should I know? And so there are a number of things to keep in mind. Everyone thinks about value, and that's certainly one of the most important aspects of selling a company, but there are other aspects that are important. And those are structure and timing and some other things. So we'll start with value because it's the first thing on people's mind. And with value, what you want to make sure you do is get an independent valuation or an independent look at what your company's worth. It doesn't have to be anything fancy. It's just somebody that can tell you what your company's actually worth. And there are a lot of rules of thumb out there, and rules of thumb are fine, but many of them don't hold water. And they're also based on averages. So they don't necessarily represent the true value of your company. Your business might be the largest asset that you have, so you don't want to leave it up to chance or guessing on what it might be worth. One thing that is almost always true, though, is value is based on what a buyer can realize in terms of cash flow. So your number of years in the industry, your licenses, your full office space, none of that really adds value beyond what it can do and what it has done to produce cash flow. I have a lot of business owners who come to me and ask if untapped potential has value. They either don't have the time or they don't have the resources to grow a potential revenue stream. So they think that a buyer with the right marketing power can harvest that for them. And they can, but also what I've seen is the buyer might pay this value, but as a contingency over time. So that might be there. They might pay for it, but they're not going to pay up front for something that isn't yet harvested, that isn't yet realized. So these are just a few things to consider when it comes to value. And the other thing that I should say is buyer might pay value as a contingency in this industry in general. And that's because, we're really basing these valuations on relationships and not hard assets. So that kind of, that's one of the things that I think people ask all the time is, well, can I get cash at closing and that sort of thing? And a lot of times what you're looking at is more a combination of cash at closing and earnout, so which is contingency based. And Kelly, I don't know if you said this, but if anybody has a question, I'm just talking, but if anybody has a question and they want to put it in the chat, I'm sure that I'd be happy to answer those. I'm sure somebody's fielding those, so.
I was supposed to say that, so thanks,
Okay.
Jamie. I didn't. Yes, if
No,
you have questions.
And this is Dave. We already have a couple questions that have come in. So one of them I think you might have answered. Is it better or worse to sell a business in 2021 after a year like 2020? Or how about buying a business? Is it better to buy a business? And then the other question that I saw was, should an owner offer to stay around if they want to sell their business? Is that a good thing for them to offer that, or is it a bad thing? How would you?
Those are good questions. Those are good questions. So if it is in your financial plan to sell your company in 2021, it's definitely something that you should look into. I would say there are a lot of buyers out there, and I don't necessarily think your value is going to take a hit just because of what's happened, because a lot of the valuations, so in this industry, a lot of what you're going to get paid is the performance over the future. So you'll get paid something at closing usually, and then something over time. So if sales are picking back up and you expect them to return to historical values, then you will end up getting paid what you would have pre-COVID. So that's what we're trying to do, is structure deals that allow people, if they do want to sell in 2021, to realize that value should sales return to historical levels. Now, if sales don't return to historical levels, then the argument is made that the company is not actually worth what it was pre-2021 anymore, which is why you'll get less for it. And there's one concept that I think a lot of people don't realize is, and think they might realize it more now, is selling a business, it offers some risk, right? You have a contingency portion of the deal and the buyer's taking over control and they feel that there's risk involved in that, and there is. But there is also risk in just owning the company yourself, because you don't have control over so many things that are out there right now. So actually selling your company and taking some chips off the table actually reduces risk. And then I think that, what was the other question? Oh, if the owner should stay around. I will get to that. We're not quite there yet, but I will answer that question. So I kind of want to put this into a bit of a comparison. A value of a company is driven by the same thing that drives value in any investment, which is the return. And so a buyer, I want to say this right, it's its ability to produce cash flow. So it's not driven by all those things that I said, the coolness of your office and everything. Those are things might be of interest. Your culture specifically might be of interest as selling points, but they do not determine your actual value. So let's say for comparison's sake, these are terms that most people understand because they bought and sold house. Let's say you're house shopping and you like the tile in the bathroom, or you like the color of the paint, or maybe you like the style of the flooring or the carpet. These might be selling points for you, but it doesn't make the house appraise for higher. It just doesn't. The real value drivers are location, square footage, number of bedrooms, and number of bathrooms. And so it's all about the fundamental statistics, and the rest is necessary. And you can't sell a house without flooring and tile and bathrooms and that sort of thing. You can't sell it without that. But you also can't pay more for the house because those aspects are taste specific and they would change from buyer to buyer, which is why you can't put more value on them. And so the same is true with companies. It's very much tied to the return that the buyer will get. And so I want to talk just for a second about some of those statistics. Your buyer will want to know cash flow, your gross margin percentage, maybe your number of salespeople, potentially the ages of your salespeople or their status and whether they're planning on retiring soon. So, I mean, like I said, don't get me wrong, the other things matter. The culture matters, the experience of the employees matters, whether you're forward thinking and embracing current market trends, that matters. But they're important that they will attract buyers, but they aren't fundamental value driving points. So I want to, make sure that I'm clear about that. And I'm not saying that culture isn't important. It's very important. It's very important for a match, but it's not a value driver. Further to what I was saying, and this will kind of answer one of the questions that somebody was asking, is second to value, and it's a very close second, is structure of a deal. So structure refers to how the value will be paid out and under what terms. I could tell you they'll give you $1 million for your company, and you don't really know whether that's a good deal or not because you don't know how I'm planning on paying it. I could say I'd give you $1 a day for 1,000,000 days. And that deal, no longer looks good. So it's important to understand the structure when you're deciding whether a deal is right for you. There's almost, like in our industry, there's almost always an element of future payout based on performance. And this is because of two main points. One is the lack of hard assets. We don't have a lot of hard assets in this industry. On the supplier side, that's not necessarily true, but on the distributor side, it absolutely is. On the supplier side, you might have more equipment and that sort of thing, a building, that sort of thing. So you would expect more cash at closing for that sort of thing. But on the distributor side, you just don't have those hard assets. So that's one of the reasons. And the other is the revenue stream is, in revenue stream, you have to think return, which is what a buyer is looking for, is based on relationships that the buyer doesn't have yet. So in order to get full value, you as an owner have to demonstrate the relationships and the related revenue can be transferred successfully. And now some people might say, well, isn't that the buyer's responsibility to keep my customers happy? And yes, it partially is the buyer's responsibility to make sure that they enable the retention of those clients with their resources and their platform and that sort of thing. And this situation is just speaking in generalities, but most transactions have a balanced risk between buyer and seller. And it really needs to be a good marriage of risk, culture, all of that to be successful. And it's really important to have a strong transition plan in place between the buyer and the seller. Further, both buyer and seller need to understand that they have the same goal to maximize the performance of the company. So a lot of sellers will say, well, what if they sign my sale so they don't have to pay me as much? Well, first of all, you wouldn't sell your company to somebody that you thought that was their intent. You shouldn't sell your company to somebody where you thought that was their intent. And if you do well, they do well. So both win. It's a win-win when the sales are higher and everybody's happy. So
Jamie, I wanted to, sorry to interrupt. I wanted to ask you sort of along those same lines, if an owner is looking or starting that process of considering, selling their business, getting a business evaluation, that type of thing. Can you share a little bit about maybe CMC specifically and what you guys can offer that's a little bit different than if they just go to someone that has no industry knowledge, and it's based again on some of the things that you already touched on? But maybe I do know that people that we have spoken to sometimes don't necessarily understand how that business is truly evaluated. So maybe touch on that a little bit.
Right. So you're asking what our position brings to the table in terms of being specific to the industry. Is that what you're asking?
And I do know too that in the past that you've had people that come to you after possibly already, talking to someone outside of the industry about what their business is worth.
Right.
And sometimes their expectations are a little bit unrealistic. So
right. So we do have a unique industry. So that's number one. And the structures can be somewhat unique. So it is important to get a value analysis from somebody that knows how deals are done in this industry. So somebody outside the industry wouldn't necessarily have that background. Also, they wouldn't have the contacts as far as what's going to be a good buyer for my company. We tend to contact a number of buyers, so those contacts are important too. But and overall, at the end of the day, our valuations aren't just computed. They are actual ideas of what we think we could sell your company for, and we're not going to overcommit on that. We're going to be realistic and we're going to be conservative with you. So we're not just trying to gain you as a client. That doesn't really do anybody any good, because if we can't sell your company, then nobody wins. So I would say those are the two key points. And we do have a few other questions. So I was just getting to the should an owner offer to stay around. So because of the structures that we see in this industry, and I would say the deal tends to go anywhere from 3 to 5 years post-sale. If it were me selling a company and my value was going to be partially determined by sales or gross margin over that time, I would want to stay involved, especially if I was a key salesperson. So the answer to that question, should an owner offer to stay around, and if they want to sell their business, if so, how long? I would stay, if I was in a key sales position, I would stay around as long as the deal terms for. So if you're getting paid as a percentage of something, gross margin or sales or something over 3 years, I would stay for 3 years. Also, do you recommend confidentiality agreements? Absolutely. I recommend that you always have them. I'm assuming you're asking when you're selling your company. And so the problem here is, if somebody goes to a potential buyer, even if it's a friend or somebody, and says, hey, do you want to buy my company? I need you to sign a confidentiality agreement first. Yes, you have a confidentiality agreement for all of the proprietary information that you might send to them, but they already know without signing it that you're looking at selling your company. So you'd have to have an enormous amount of trust in that person that they're not going to tell anybody, because the act of approaching them and asking them if they want to buy your company says, hey, this person's company's on the market. And then that information is free to pass on to anybody else. So you want to have somebody else present that confidentiality agreement and have them sign it. You don't want to present it to them yourself. There's another question. What if I have a non-compete agreement with my salespeople? Will the new buyer be able to lock in the salespeople referencing the non-competes? That's going to depend on where you're located, first of all, because those non-competes and their ability to be enforced will vary from state to state. But sometimes, that's the answer, is sometimes it will work. And sometimes you have to get new ones signed. But in addition to a non-compete, and I think this is an important distinction, a non-compete agreement means that they're not going to compete with you in the marketplace. A non-solicit agreement means that they're not going to go after your customers. So I would say it's good to have a non-compete. I think it's equally as important to have a non-solicit agreement in place. So, and if there's any more questions, you guys feel free to put them down there in the chat. So we've covered the structure, and I kind of just want to go along and talk about a few other things that are important when determining, like when you want to sell your company, what's going to be important. And one of them is concentration of customers. So you have to ask yourself, is one of your customers 50% of your revenue? And if so, this creates a risk to the buyer. And frankly, as long as you own the company, it creates a risk to you as well. So diversification is really important in creating higher quality of earnings and reducing risk. And that doesn't mean that if you have a really good customer that's 50% that you go out and hire them. That's not what I'm saying. It just means you have to have a good customer acquisition policy and system in place. So it may be that you get a good number of leads by word of mouth, but it's also important to have an intentional way to generate leads. And this is a key element in not just this, but also in helping companies grow successfully. So I'm not a lead generation expert, but there are plenty of those in the industry, and I encourage you to check out some of the education at Expo. There's a lot of sales-based strategies out there. The other thing that I've heard clients say is, well, I've had that customer for so long, they're not going to go anywhere. Well, we've all heard that, and I think, recent and not so recent events would speak otherwise, but it really doesn't matter if you've had the customer for, say, 30 years, because when the company changes hands, the status quo changes, and there's always risk of losing that customer. So I'm not saying that this concentration will necessarily affect your value, but it would most certainly affect the structure and make the buyer really try and hedge that risk by paying even more of the deal value at out and not necessarily at closing, based on something in the future. So future sales or future gross margin. So how do you evaluate, another question, how do you evaluate your salespeople based on sales alone or gross profit? It's really important to be looking on gross profit. Sales alone is important, but if you have a really low gross profit with those salespeople, it suggests that they're maybe selling solely on price, and that's not the type of relationship that you really want with your customers. So and I actually touch on that a little bit later as well. Oh, another good question. What would you consider a healthy gross profit margin? My gross profit is 31%, and I have some buyers tell me this is low. So 35% is the average for the industry, and it has been for quite some time. And we compile data from just this industry, and it still stays right around 35%. 31%, I wouldn't say is terribly low. It's a little lower than average. And I mean, I would say that those buyers might be, and they might just say, this isn't my wheelhouse, and that's totally fine. But there might be some other buyers out there that see this as an opportunity. Maybe they're larger and they have better buying power, and maybe they could get better margins on your company. Maybe they could increase those for you. So I wouldn't say that 31% is too low to sell. I've sold companies that were in the 20s for sure. So we've talked about concentration of customers. And so I think what I was talking about is that buyers, they won't necessarily dock you in value because you have a large concentration, but they will ask to pay more of it over time, just as you retain that customer, and it helps them sleep at night. So another thing, and I've actually gone through this most recently with a client, is if you actually are looking at selling your company in the next couple of years, don't sign a long-term lease, because what you're doing is you're committing a buyer to use that space, first of all. And if you have a 3-year lease and you want to sell your company this year, and you're basically committing them to use that space, and you're infringing on the future cash flow payments, or the future cash flow with those rent payments. So you're taking away cash flow out of the buyer's pocket, and that's going to affect your value. So it also will restrict your audience of buyers. So That's just something to keep in mind. That's just a quick tip. Don't sign a long-term lease if you're thinking about selling. And really, if you can avoid it, I don't think there's any really reason to sign a really long-term lease anyway. And that kind of feeds into the next point, is to give yourself some time. Make a plan and start the process 3 to 5 years sooner than you expect to fully retire. Most likely, and this goes into what that question was asked earlier, a buyer is going to offer you some value in the form of an earnout, as we discussed. And that means in order to maximize your value, it will be important for you to be involved or to maintain those relationships, or maybe even grow those relationships. I've seen situations where a smaller company didn't offer as much in terms of service, like company stores, and then a larger company bought them and they were able to increase their service offering and then in turn increase sales. So that's something that you want to do. The evaluation doesn't always just come from the buyer. The seller should evaluate the buyer as well. It should go both ways, and make sure that that buyer is really offering those types of services and maybe helping them fill in some of their weak spots. And in addition to giving yourself time, I would say be flexible and keep an open mind, because you shouldn't just assume a buyer is going to be a company just like yours. In actuality, like what I was just saying, a buyer, many times a good buyer is a company that is completely different and has different strengths and weaknesses, and then you guys can complement each other. Okay, and another question that I get, and this is actually another tip, is about compensation of salespeople. One of the hardest hurdles to overcome is salespeople that are overcompensated. And the reason for this is a buyer, if they buy your company and you're overpaying your salespeople, and a buyer comes in and has to adjust the pay, well, nobody likes their pay to be changed, and certainly nobody likes it to be decreased. So this inserts more risk in the deal and makes the company harder to market, because you have to find a buyer that matches that sales compensation level. And the objection here is, well, if I don't pay my salespeople top dollar, then there's somebody who's always willing to pay them more. Well, this is absolutely true as well. And you know what? It's true when it comes to your customers, when you're selling solely on price. So the same concept applies. You don't want to pay your salespeople and just have them in your organization just because you're paying them the most, because there's always somebody that will come along and undercut, or in this case, overcut you. So if another distributor is able to pay your salespeople more than you are already paying them, and you're already paying them market value, chances are they're not comparing apples to apples. They're not getting the same level of resources and sales assistance. So I would say, on the salesperson side too, make sure, if you're thinking about leaving an organization, to compare apples to apples, do your homework and talk with some people and understand what those resources really are that are being offered by that distributor. And another point is, if you're overpaying your salespeople, you aren't keeping as much or maybe anything for yourself. And it might seem selfless to give all your profits to the salespeople, but it isn't sustainable. And in the long run, it won't be good for the salespeople or other employees if you can't sustain your business. So and this goes back to the concept that in order to build a strong, healthy, viable company, you need to make sure that the principal financial structure is sustainable. And this includes a reasonable compensation plan that is fair and at market value. And I know that the next question is probably going to be, okay, so you're talking about not overpaying my salespeople, so what should I pay them? And the way to compensate salespeople in this industry, and I'm going to speak in generalities. There's really no one way to compensate salespeople. First of all, it depends on your culture and your goals and your company model. So that's my disclaimer. A lot of companies are still using the 50-50 model, which has been around for a long time, which means 50% gross margin goes to the distributor and 50% goes to the salesperson. However, this model should, in my opinion, really only be used when dealing with an independent contractor model. And the problem with the independent contractor model for some distributors is it's being challenged, especially in the more progressive states like California. So it's literally being arbitrated and legislated as we speak. So you want to make sure, if you do use independent contractors, that you're following all the guidelines when it comes to that model. So Further, so people will say, well, why can't I just do the 50-50 split and have employees? And you absolutely can, but then you're adding additional cost in terms of the employer portion of Social Security, healthcare benefits, and you're going to end up, you're already giving so much away, you're going to end up struggling to break even if your margins are super high. So it wouldn't be my recommendation. If you have more of an employee model, it looks something more like 40% to the employee and 60% to the organization. And further, you know, and I talked about this a little bit as the larger organization can do more of an independent contractor model because the independent contractor model tends to lean towards the employees owning the customers, right? So if you're a larger organization and you lose some customers because somebody leaves and they're an independent contractor, it's much more sustainable than if you're a smaller company and you lose some customers because somebody left. So it does, the independent contractor model does work a lot better sometimes for a larger company. They're just more diversified. So a few more questions. How important is culture to consider when selling a business? It's extremely important. Part of our process is to get buyer and seller on a phone call or now a Zoom call as soon as we can, because frankly, if that culture isn't there, if that marriage of cultures isn't there, it's not going to work. It doesn't matter what the numbers look like. You know, you really want to make sure that you're going to mesh with whatever the company is. So that's why part of our process is really to get people to meet as soon as possible, even if it's only virtually. Another question, should I sell my company to an organization where I would be a 1099 or corporation, or would it be okay to join the new organization as an employee? Well, that really depends. I mean, there's nothing wrong with being a 1099, which is an independent contractor. It does yield itself to be able to deduct some like certain expenses, maybe auto expenses, home office expenses. So from a tax perspective, it might be more beneficial, but you're also going to lose the benefit of having the employer pay your portion of the Social Security taxes. And also, and that's, I mean, that's not a huge percentage, but it's something. And also you won't have the benefits. You won't have the benefit of benefits. So that's the other reason. So I would say if they're offering as a 1099, the compensation structure should be higher than if you join as an employee. So you want to compare that and compare those percentages and figure out which one is going to look better for you. But it's, you know, absolutely an individual choice, and both have their own positives and negatives. And do buyers typically offer both options? Not usually. Honestly, I have seen it more lately that people are trying to be a little bit more flexible, but usually a buyer will say, hey, this is our compensation package, and they want to be fair. They don't want to bring people in, because you do have the concept where you bring people in and they're already, you know, different. You know, they're already new additions, the new kids, and you don't want the new kids to be ostracized by having a different compensation plan in place. So usually they try and, you know, sync up compensation plans so everybody's on the same plan. It's easier for the buyer, and it's easier for HR and all that. Oh, and we already spoke about the average margin for the industry, but it's worth saying again. It's 35%, although I see a lot of very high and I see a lot of very low. So again, these are generalities. And what I talked about earlier is that you can't solely sell on price. Someone will always undercut you. And if you have customers that are buying based on just price, those are customers that you don't need to be chasing. Assuming you are offering the creative content and really developing strong campaigns for them, your clients, you shouldn't have to sell your clients just based on price. And another thing is you cannot make up for poor margins with higher volume. This is a really common misconception. You will undoubtedly have higher costs, whether it's additional customer service or additional space. And that's just how the financial part of the business works, is there's always those variable costs in there, whether you see them or not. So don't chase people that are just buying logoed pens on the internet. Those aren't your customers. And again, if you're, you know, at a loss for a customer, for building a customer acquisition strategy, check out one of the presentations in the industry. There's so many good ones out there, the people that are working on sales strategies. So that's basically all of those are the main questions that I get. And I want to kind of leave it open if anybody has any additional questions or, wants to chat about anything. I'm happy to do that. I'm happy to do that. If you don't want to ask it on here and you're not comfortable, you're welcome to message me or email me as well.
Jamie, there was so much great information there. Thank you so much.
You're welcome.
Any questions before we wrap up? Dave, I know you have questions. Oh, you muted yourself.
Oh, it's muting and unmuting. There
Okay,
you go.
leave me alone.
Technology is hard.
No, I just sent her one, and it was how long would Jamie say it typically takes to close a deal?
To close the deal. Okay.
I've heard it takes 2 years. I've heard it takes 20 minutes.
It takes 20 years. No, I'm kidding. Our whole process from the point in which we meet a customer or a client to the point at which we actually close the deal, the average is 6 months. But there's nothing wrong with positioning yourself so that you want to take time to find the right buyer, that it could take a little bit longer than that. And there's also nothing wrong with saying, hey, I met you, you're the one, I want to sell my company to you, and it takes 60 days. I would say it never takes any less than 60 days. That's a pretty rushed transaction. So if you're selling your company in less than 60 days, there's probably something else going on there.
I'm just thinking about something else. Now, the only thing I would add before you close up, Kelly, would be just if somebody's looking to sell their business or if you're looking to buy a business, there's no harm in asking questions. There's no harm in reaching out to people like Jamie and other people. You can enter into a contract that may involve some money, but you don't have to do that. You can ask questions, and nobody's going to make you sell your business. Nobody is going to make you sell your business, or that nobody's going to make you buy another business. That you hold the cards. And I think the message here that we were hoping to give out was just make whatever decision you make an educated decision, and don't rush into it. Do your due diligence, and you won't have any regrets.
Absolutely.
Jamie, thank you so much. This was so informative in every way. We appreciate you being on here. Do you want to share your contact information? I am going to share it after the event with everyone, but do you want to go ahead and share it now, or I can read it off?
I can share it. Yeah, it's pretty easy. And I'm going to further to what Dave said. Absolutely. I'm an open book. Call me, email me. I'm happy to answer questions. I want to be an ambassador of knowledge for this. Even if you're not a client, I want to make sure that things go smoothly for you. Mergers and acquisitions are, they're hard. They're difficult. You built this business. It's easy to hear somebody talk about, but it's harder to do when it's your business. So I want to be an ambassador of knowledge for the process in general. So my email is jamiew, JAMIEW @certifiedmarketing.com. And we are on social. What's that?
I was making sure you saw that.
We are on social media, kind of. Just Facebook, and it's /certified marketing. And I think it's pretty easy to find. If you put in certified marketing consultants, you'll find it.
Jamie, I also wanted to mention real quickly, it's a great time to do another little plug for anyone who joined us late for your new text preparation, advice, guidance, that kind of thing, that's a new service that you guys are offering that I don't think anyone else in the industry is really looking at all. So do you want to mention that real quickly and what you guys can provide?
Sure. So I've always thought that offering tax services would round out our kind of cradle to grave consulting services and planning and all of that for people. And I've never had the bandwidth to be able to do it myself, or to be able to prepare state returns in every state. that takes an infrastructure that we just had not built yet. And what I realized was, rather than build it, we're going to partner with a company out of Orlando that I have done a lot of due diligence on. And they're not the type of company that's going to say, give me your information and I'm going to prepare your tax return. No, they're very involved. They're very good at tax planning strategies. They have a 2-to-1 rate of return in the first year, which means if you're going to pay them a certain amount, they're going to find twice that for you to save. And if they can't do that, then they're going to be upfront about it. And they'll still take you on as a client if you want, but that's their overall goal, is that 2-to-1 rate of return. So it's really, and they're also really good in automation and a lot of things that I think our industry could really benefit from.
Jamie Watson, lovely to have you. Thank you so much. We
You're
really
welcome.
appreciate you.
It's great talking to you guys.
Take care.
Thank you. You too.